Hi, hello, Wall and Karen, and this is MIAO. So now I will do a short presentation related to my dissertation. So, as you see, my topic was dividend policy and share price volatility, and I use the UK evidence. So today I gonna teach a focused and specific topic in my dissertation. So that is how the dividend policy affect the share price volatility, and to do the analysis by using Excel. At the beginning, to make sure everyone have basically understanding of my dissertation, I will do a brief introduction of my topic. In my study, it aims to investigate the correlation between dividend policy and share price volatility. To finish my study, the first step is to do the data collection. After the data collection, I have to use the existing models from previous studies to do the further analysis, and then list all the data in the Excel and get the results. So firstly, I'm gonna introduce you how to do the data collection and where the data from. So most of data utilized was extracted in the list of FTSE 350 from a 10-year period in United Kingdom. As you see, is from 2003 to 2012. The high and low share prices for the year which were required to calculate price volatility. So there is a need to collect the announcement dates for any capitalization changes from monthly UK stock exchange journals. Some other data also need further calculation, such as payout ratio, firm size, growth in total assets, and earning volatility. Especially in earnings volatility calculations, it requires using 3 years data to do calculation of standard deviation. For example, for calculation of earnings volatility in year 2003, this should be used data for 2000, 2001, 2002, and 2003. So, the data of earnings before interest and tax in period from 2000 to 2002 should also be used. For use of this study, these extra data were added in the data, and these data were also directly obtained from data stream. Moreover, companies were classified into broad categories such as food producers, chemicals, software producers, and so on. To help further analysis, these companies were reclassified into two groups, which are services and general industries. And next, there is another important step is to sifting data. So at the beginning, over 300 companies' data were collected. But the large data has to be sifting because due to some specific reasons, part of data is not available. For example, in company American Barrick Gold, the data of earnings before interest and tax is missing in year 2003, and the long-term debt and total assets for the company are not available in year 2003 as well. So this company has to be deleted. Due to similar reasons, many other companies with missing data were excluded from my sample companies. So at last, 101 companies are extracted as sample companies. And now I will introduce the control variables. Stock price volatility. Stock price volatility should be related to the basic risk encountered in firms' products markets. Dividend policy may also affect by market risk. Therefore, control variables should be considered for the variability in the firm's earnings stream. And holding operation risk changeless. Higher financial leverage should be a case of greater stock price volatility. Dividend policy and debt may be interrelated, so the controlling of debt is as well as important in corporate leverage. And next, I want to show you what's the definition of variables. So firstly, this is the most important one, is the share price volatility. This is dependent variables in regression formula, which is based on the annual range of adjusted stock price acquired from data stream. To calculate price volatility, firstly is to use the highest share price minus the lowest share price in 1 year, and then divide it by the average of this range, then square. For example, more specifically, in company A, the highest share price is 161.38 and the lowest is 123.48. So we have to use the bigger number minus the smaller number and then divide it by the average of these two numbers and then square. We can get the result is 0.106. So by following this way, the share price volatility can be calculated for 1 year and each year. And then the dividend yield. This variable is considered to be explanatory. It is calculated by all the cash dividends annually paid to the common shareholders and the market value of common stock at the beginning of the year. Figures are directly from data stream. The average was taken by all available years. And payout ratio. The figure of payout ratio was calculated as the dividend per share divided by earnings per share. The data dividend per share and the earnings per share is directly from data stream. And the firm size, the market value. To calculate the size of firm is simply use the annual share price multiplied by the number of shares and then transform this data by using the base 10 logarithm. And earnings volatility. For earnings volatility calculation, is use the 3 years data to calculate the standard deviation. And as my previous mentioned, that's the same. So it should be as follows. The earnings volatility of year 2003 should be used the data of 2000, 2001, 2002, and 2003. And the long-term debt. Figures for long-term debt and total assets were obtained directly from data stream. It is the ratio of companies' long-term debt to total assets and the growth in assets. The yearly growth rate was calculated by taking the ratio of change in total assets at the end of the year to the level of total assets at the beginning of the year. So after all the calculation, we can list all the data in the Excel and use the models appear on the screen. So the model is like this, and you can see the earning volatility and dividend yield. Earning volatility is dependent variable, so we put in the front. the dividend yield, payout, size, growth, and debt are variables. So here I'm gonna simply show you the Excel. As you see, so we list all the data in the Excel. So here is the price volatility, dividend yield, payout ratio, size, earning volatility, long-term debt, and growth. Here is the company's name. So we can use Excel to do the data analysis. Here is the results. This is not complicated because it can be finished with the software. So we can get the coefficient here, p-value, standard deviation, and error. And we can list this data in the table. In the table. So as we see, we list the coefficient, t statistics, p-value, and observation. Observation means I used 101 companies and 10 years data. So 101 multiplies 10. So we got to 1010. So here is the star. It is the significant negative of the relation between the dividend payout and the price volatility. And next, we get the results. The results suggest that there is a positive significant association between dividend payout and the price volatility, and this relation even not reduced after included other control variables for firm size, debt ratios, earnings volatility, as well as growth in total assets and industry. So what the benefits of this analysis? It is to help managers to have a basically view of the trend of share price changes. So when they do the investment, they can have a clue to decide their investment and manage their risk. Okay, that's all. Thanks for listening. And summer holidays will be coming soon, so hope you have a wonderful summer holiday. Thank you. Bye.